to anyone around this arena. If you're investing, if you're an entrepreneur, if you're thinking about investing, if you're putting deals together, then an understanding to begin with of the perspective of both the investor and the entrepreneur becomes central to what we do. Part of dealing in the startup arena, or part of the difficulty of doing it, is these are not mature companies, typically, obviously, by definition. Consequently, your ability as an investor or as someone doing due diligence on one of these companies is quite difficult. And a lot of times the information stream, the data available to you is quite constricted. Consequently, you have to make decisions based on what you know or what you can glean from both the company, but also from the entrepreneurs themselves. I have with me Gail Kitch, who's one of our members, and Colleen Watson, who's online. And I'd ask them to give you a little bit of perspective. I know that's a cold intro to what we're going to talk about, but nevertheless, I think it's interesting to hear from two folks that are experienced in having done it as investors and as deal leads, to give you some understanding of what it is that is needed to be done in order to do a deal. Yeah. The difficulties you'll hear in a moment from Colleen relate to, as I said, the fact that there's not a lot of data about these companies. And many times you're looking for subjective attributes of the entrepreneurs. Yeah, you really are betting on the horse. Betting on the jockey, not on the horse. And I think Colleen and Gail's experience will bear that out. So with that, I'd like to turn it over to Colleen, who's online. She's one of our members and also an experienced deal lead and investor. Colleen?
Thank you, Craig. Just to give you a little bit of background on me, I'm actually a data analyst. So coming into this arena originally, it's very different because there is very little data, but I still like to concentrate a bit on the numbers, so that'll come through as I'm talking. But I see the deal as two different parts. One, is the company going to be successful? Two, if it's successful, are you going to get any money out of it? If it's not successful, what do you lose? And I feel like answering that second part first when you're doing the due diligence is fairly important, so you don't go on this long tangent of, what are the possibilities in getting enamored by how great the entrepreneur is, but looking at what their capital structure is at the point in time that you're entering. Is there room for you? Even if they hit it big, are you going to make money? I once looked through all of the documents, and at the very end of a lot of research, I found out that there was one round of financing that was going to get 7 times their money back before anybody got more than 1 time their money back, which was going to be very difficult for anybody to get any money back then. So looking through the documents, looking through deals, figuring out what the waterfall is. I'm sure Craig will talk more about the waterfall later, but figuring out sort of scenario wise, is there money available and are you going to be cut out of it? And sometimes I feel like the entrepreneurs aren't even as aware of what's going on as you would like them to of the capital structure, and just making sure you know all of the little points. And that means reading through the different documents, the convertible notes, the issuances, knowing the legal structure of the company, and understanding sort of the players that are at play there, right? If it's brand new, then there's not much to look at. If it's a little bit further down a couple financings, then you want to make sure that somebody hasn't snuck in there, or, the entrepreneur hasn't structured it in a way where they have all the voting rights, or just knowing sort of how things play out in the scenario that it goes bad or it goes well. And then from there, looking at, okay, do I think this is going to work? It's a startup, so there's not a lot of data. Oftentimes you're looking at, okay, is it a good idea? Is there a market for this? And then also, do you trust the entrepreneurs and the people that you're working with? If you're going through the documents and you find something hidden, I end up not trusting them, and I don't want to invest in a startup that I don't trust the entrepreneur. So those are sort of the key things I look at when I'm going through it, and trying to determine, what are the next steps, and where we go from there, making sure, there's going to be enough money to invest, there's they aren't going to be coming back for a financing right away, and that you're going to get something out of it in the end. Craig, do you want me to elaborate on any of that, or?
Well, let's ask. Colleen has a 6 o'clock hard stop. So if you have questions for Colleen, Gail, we're gonna keep here, but Colleen's gonna take off at 6. So any questions about that? I know that's also a quick introduction. You mentioned waterfall and things like that, that if you're not familiar with waterfall, we'll talk about it later on and why it's important to these deliberations, but those are good points. Yeah. And
I have
I
a
think
quick
Colleen,
question.
you said, I'm sorry?
I have a quick question for Colleen.
Oh, Wendy, yeah.
So the capital structure is a tough one, right? Pushing on an entrepreneur as to, at least what I've found, they seem to be very hesitant to give you all the detail behind their issuances, and this is in my limited experience, but will you please send me all of your investors and what they own? Sure. And then no. Will you please send me detailed on your tax report so I can look into how your capital structure is? And then there'll be these lines on their balance statement that say goodwill. In other words, getting the detail behind all that on a angel investing level versus annual reports, SEC filings, where you've got that detail and you've got that grist to analyze and get down and dirty and get it. What's a maybe one quick tip to get to that data and a very nice, polite sense of urgency way of getting that information into a shared document so we can start getting that information in our hands? In other words, I have not found a way to do that.
So often what I'll say to companies that aren't willing to share that sort of data, because that's sort of, you need to see that data to be able to know what you're buying into and to know what you're like. Sometimes they'll offer a waterfall and you want to make sure that's waterfall. You could get that certified. You could get something else. But often what I'll say is, I need these things to move forward. I don't want to waste your time or my time by having a bunch of conversations until I understand what's going on. And so I need those documents to move forward. They have limited time as well. And so saying that, sometimes they'll say, well, I won't give that to you. And you say, okay, well, then we can't invest.
So you've, this is not usually a speed bump.
I have not found it to be a speed bump. If it is, I'd be very, in the companies that I've done due diligence on, which I don't know, there's been a handful, but there's at least 5. I've never had a problem getting the information I need. They might not give you the full balance sheets or the full cash flows, but they'll at least give you, what, and maybe they don't give you the investor names, but at least what the documents are and how much is in each round and how it's structured, right?
We're not, what even the percent of who owns what stock and all that good stuff is a problem. So
yeah, if they say X, Series A is owned by this, Series A is this much, Series B or whatever, right? Sometimes they give you more broad picture because they don't want to go into the detailed names, but oftentimes I get very detailed names, which I don't really need. But sometimes it's helpful because that somebody with insight into the industry is investing, and so therefore it's interesting. But if it's their dad or something, that's also interesting, I guess. But oftentimes they'll give it. The only one that I've had hold up right now that I've said, I'm not, come back to me, I'm not wasting my time until you're ready. I've had a couple that I've done it too, but the one right now is we were not going to be deal lead. They needed way too much money for Can to come in as the deal lead. And I said, once you get a deal lead, let me know and let me know what the terms are, and then we can move forward. But I'm not going to do a bunch of research right now if I don't even know what we're dealing with, right? And so it doesn't shut down the conversation. It just delays it until they're at a place where they're able to give you that information.
Sometimes, Wendy, there's not the polite way to do it. Sometimes you have to be a bit impolite and simply say, look, if I don't have this by the end of the week, we look at 500 deals a year. There are plenty of other deals that we can invest in. As Colleen said more politely, we're not going to spend your time or ours. Period.
Yeah.
I have to do that. I've done dozens of them, and I've done that just in one case. And in that case, gosh, I got the data pretty quick.
Yeah, I just, fair. I'm just, okay, thank you.
Sure. Any other questions for Colleen? Before she's got to take off? Colleen, thank you very much.
No problem. And if anybody does have questions, feel free to email me or connect with me otherwise.
We've
Thanks.
got the- So before Gail, I ask you, let me finish this list to sort of outline what we're going to do and then relate it to one topic that's come up already and that'll come up throughout this and frankly, any other investment. Yes, even if you have SEC filings and audited financial statements, et cetera, you're still dealing with people. And in a startup situation, obviously you're dealing much more intimately with the startup, with the entrepreneurs or entrepreneur as the case may be. So finish up the intro to this. In order to do this properly or well or successfully, so to speak, success, of course, in startup arena, you understand, is not the success you might have in a normal situation. This is risk capital. Yeah, we understand that, and everybody wants to hit Facebook. Not everybody does. So make sure you understand that startup investing is investing risk capital, capital that you can lose and not change your lifestyle, is usually the way it's described. Be conversing with deal terminology. You just heard the term waterfall, you heard the term participating, non-participating, liquidation preference. There's all sorts of terms that float around VC and investment deals, startup deals. You need to be familiar with it because when you start talking to the entrepreneur, start looking at a term sheet for what it is that you're being offered, you need to understand what it is that you're being offered. If you're analyzing in due diligence a waterfall, you need to know what it is, what it's supposed to represent, and where the assumptions come from, and the assumptions that are put into the waterfall. We'll talk about that later. Solicit sufficient information. That's sort of Colleen and Wendy's topic is, okay, I asked for a darn capitalization table. If you don't know, simply lists who owns what of the company. Founders own 80%, grandpa owns 12%, grandma owns 3%, et cetera. That's a cap chart, capitalization chart. You need that, obviously. You need to know where you stand ultimately with your investment among the other investors. When either your debt converts, we'll talk about that, or as you buy equity, where you stand immediately. Do thorough due diligence, and I put that in quotes for obvious reasons. Thorough is relative to what it is that's available. Yeah, if the startup, and boy, I tell you, I've seen startup companies with no operating agreement. In other words, no bylaws, no operating agreement, no nothing, no employment agreements or anything, which is fine. I understand that. The entrepreneurs are passionate. They're not going to waste time and money on lawyers. So they get going and they start building a business. And then you find in due diligence that there aren't a lot of things you normally expect a company to have. Identify red flag issues. That's where we get in. We'll get into due diligence and what are red flag issues. And the way I do this is to describe for you what I think are red flags. When you're going through certain material that you get from a startup, there are things that pop up and you go, wait a minute, that's weird. Or gosh, that doesn't sound right. It's those are red flags. We're not teaching, I had a staff of young attorneys who did all that stuff and they knew exactly what to do, what to write, who to call, where to find the information. That's not what our deal leads or investors typically do. What you do is you find something in the documents that's out of sorts, that's odd, that's different, what's normally there, and that's a red flag. And then you go find somebody else, a colleague, a member of the due diligence team or whatever, and ask them about it. Understand the cap table and waterfall. I've talked about that already. I say here, negotiate the term sheet. Ever more frequently in the angel investing world, we see term sheets already done. Yeah, everybody knows where to go online to get Cooley documents. They've got a term sheet and it's standard stuff. So many times now, 90% of the time, we come, an entrepreneur comes to the investment group and already has documents done, which is fine. The Cooley documents are fine. Hopefully, though, when you look at them, you understand what they say. And frankly, hopefully the entrepreneur understands what they say, because many times they don't have a clue. They just pull them down because they think they know they need those documents. And last, understand the form of the investment vehicle and complete the investment. That's more for our deal leads. And I'm not going to spend a lot of time tonight on telling you how we set up investment vehicles and get a tax ID number, et cetera, et cetera. So let's talk about the perspective, and then Gail, I'm going to ask you to speak. So the perspective, you need to understand, as I said at the outset, in order to do this successfully, you got to understand two things. One is the investor side. Whether you're an entrepreneur or an investor, you have to understand both sides. You have to understand what the entrepreneur is looking for and what makes a deal work, or better put, what at the outset can kill the deal dead. Yeah. So looking at it from the negative point of view, investor is going to drive the hardest deal she can because she's got the money. Then the deal's going to fail. And you can do that sometimes. You know, a hungry, passionate entrepreneur comes to you with a dynamite idea. He spent a year developing some product and he's really excited about it. And you come in and say, I'm going to give you 100 grand, but I want 85% of your company. Yeah. I mean, that's an egregious example, but that's my point. The point is driving that deal down the entrepreneur's throat is not being cognizant of what the entrepreneur is looking for, but perhaps the entrepreneur doesn't even know what he's looking for or needs. And what the entrepreneur needs from the angel community is a partner, not a financier who's going to slit his throat. Yeah. So understanding the perspective of the entrepreneur and the angel investor is important. The angel investor's perspective, now it varies. I'm speaking, I think, for the majority of the investors that I invest with. Our perspective is we love the fact that we have the ability to support young entrepreneurs. Well, they're not always young entrepreneurs, but usually they're young entrepreneurs. We love the ability to mentor to some extent. All of us have experiences in different walks of life, and it's fun to find entrepreneurs and mentor them. So the ability or the willingness of the entrepreneur to be mentored is important to us. And now we're getting into attributes of the entrepreneur themselves, which are important to the angel investor. I don't want an angel investor who thinks she knows it all and will not listen to the investors. The investment community, particularly our investment community, is a wealth of information, experience, connections, etc. And an entrepreneur that's unwilling, that is so convinced of her infallibility is not the kind of entrepreneur you want to invest in. You're looking for that merger of interests, the ability to openness, to solicit and act on advice from people that might know more than the entrepreneur, etc. Angels invest, of course, for money. It'd be great if we all made billions of bucks, but that's not the main motivation of most of our investors. There are tax advantages, as I said, mentoring, giving back, advising, and learning. It's really interesting. I never knew, my background was philosophy and law, and now I'm really knowledgeable about enzymatic fungicide, for instance, which
I know you were looking for Rebecca. When you said that.
I know. I just wanted to say that because it's cool. I know things about enzymatic fungicide that I never knew before. I know things about making steel with hydrogen. You know, that's not a startup, but it's another thing. So part of the fun of investing, part of the intrigue of investing is just learning about new stuff. I mean, we've got 75 companies. Every one of them is different. Learned a little bit about distillation, learns about enzymatic fungicide, learned about cybersecurity, and on and on. And that, I think, motivates a lot of us as well, because particularly if you're my age, you got in the niche, you know, and you had a career for 45 or 50 years, and it's fun to kind of spread out and A, be able to use that experience, but B, learn new stuff. So that's, and hanging out with fascinating folks. So I think you get the notion that our group is a group of wildly interesting people from every walk of life, from 28-year-old, is that the youngest guy we've got? 28, 27, sorry, 27, all the way to Jeep, who was 83.
Yeah.
So anyway, the point being that that's our motivation. So you, if you're an entrepreneur, need to understand the motivation. Yeah. The expectations, well, if we're talking about money, 2.5x and a whole period of 4.5 years, it's probably wrong in the current environment. Exits are not happening as frequently as they were a few years ago, primarily because of the economy. Investment, I think, generally is down because everybody's holding their cards close to the vest because nobody knows what's going to happen in the economy. And this just repeats, I think, what I was saying. And I think at this point, Gail, I'll stop and ask you to talk a little bit about those attributes that we find important when we invest.
Right, and I want to say something at the beginning about, certainly about another aspect of CAN, which is, you know, you can't know everything. One of the, because I brought less of a like deep understanding. I knew sort of what it was or whatever, but the other piece that's interesting about the group of people who are involved is they are eager to share. They too have lost money. I said to Craig, I said, I came in thinking, well, these guys talk, and it is mostly the men talk a good game, God bless them. And you would think that all they ever had were successes, or they're very quiet about it and you assume they somehow had successes. No, pretty much everybody has the experience of like, there's only about 10 or 11% of the deals actually hit big. So you really do have to go into this understanding that you are going to lose most of the money you're going to invest, but you're going to, when it does work, it is a big deal, so it's kind of fun, and people can tell stories about the big deal. So that is something which keeps you all holding on. But you also have a group of folks who will share with you what that experience is. And I think that was something which I really appreciate. People really do want to share, and I'm thinking in particular about the deal lead piece of it, because it is kind of a slog a bit, I mean, it's kind of like you think, oh, no big deal, but no, it's a wonderful way to understand the process of what it means to be an angel investor if you're a deal lead, because you really do have to think about, I mean, I went through this training, just what you guys are all doing now. But when you live it by having to be the deal lead, you really live it. And it's a wonderful experience to learn and to really begin to internalize what it means to truly know everything you can about a particular entrepreneur, to the best, to its great and extent as you can. Now, you can have problems with back to what we just talked about. I mean, there are also things like the guy who turns out to actually be the kind of, the duplicitous person that you sort of had a sense of. I mean, I guess stuff. So what are the pieces that make it work? There's a human component. There really is this gigantic human component to all of this. So trust your instincts. If you know something about an industry and something just doesn't jive, trust that response, probe, whatever. But the deal that I got a total loss on thus far, although some of it living, was somebody who, when I thought about it, I thought he was just a little too shiny and a little too slick, even though it added up. And I thought the deal, but it was a compelling presentation and willing to do it. And it was sad because even his co-founder was basically misled by this person. But when you thought about it, there were warning signs there. So listen to your instincts, because it's really going to come down to the person who's in front of you, people who are in front of you. And if you get an instinct that something isn't quite right, trust that instinct, because chances are at this level of what we're doing, this is actually that can make that difference. But as I said, I think also trust the folks who are with you in the group, because they really are eager to help and willing to help. And if you don't understand something, bring it up, let people know, ask people for input. People are really, yes, Craig and others, but everybody in the room is willing to help you and eager to help you be successful at it. And it's sort of hard to get over that hump. Certainly if it's your first time or your first couple of times, you don't want to sort of necessarily ask too many questions, because you want to walk in as acting like you know what all this is, of course. Well, you don't. And like I said, everybody has lost money before. So, make sure you do talk with other people and make sure you do share information, because I think that's a really, really important part. And as I said, trust your own instincts, bring what you bring to it. And so when it's equal, the other side of asking for help for others is when we're at CAN meetings, or even if you're on work, ask everybody for help, ask people for their insight, because you really have a fabulous wealth of knowledge in the room with you, and you should take advantage of that, because there are folks who bring really, really interesting experiences that might provide you insight that you never would have had yourself. And that's going to be true as an entrepreneur, because these are people who can be your advocates. We really do want to be your advocates. So certainly from an entrepreneur side, but certainly from an angel investor side, and from a CAN membership side, folks are there to help you learn how to be successful on this little journey that we're all going to be on. And I think that's taking advantage of the people side of it. I mean, the money's the money, there's no question about that, but taking advantage of what the people bring is the part that can make a real difference. And as I said, just prepare, I mean, I've now decided to look at this as, you know, and I think this makes sense, you know, angel investing is just another component, like a way to add risk to your portfolio, right? I mean, you know, view it as it is about the journey, but it too is another piece of what you're doing across the board. Some people do real estate, we do hand investing. And so, you know, the losses are just part of the ride. You learn from them as well. But so it's a marvelous learning experience. And it also, as you do more, as you're more involved, you learn how to ask better questions, see what works and doesn't. You learn from the bad, you learn from the ones that didn't work out that you thought you knew about. And it's just a really interesting way for an angel investor, him or herself, to learn as she's going along.
Great, thanks, Gail. So you'll see those couple of themes that we've now touched on come back as we go through this material. One theme that comes back frequently is obviously the entrepreneur herself. Yeah, and that's subjective. To a certain extent, you might have objective criteria, like the entrepreneur built a company and sold it for $1 billion. That's a good imprimatur, you know, but most entrepreneurs haven't done that. So you're really trying to get a sense of, is this person capable of doing it? And we'll get into a little bit more detail about some of the ways in which we can evaluate an entrepreneur. And it has to do with a lot of their projections. Yeah, when an entrepreneur projects the financial forecast, I love to use those to base my questions on, because you can really see whether an entrepreneur has thought through the assumptions being made or not. And when I say attributes of successful investments, doesn't mean if you do these things, you will be successful. Let me underscore that. I should have put an asterisk and a liability waiver, and this doesn't mean it will be successful, but you rarely find an investment that does a good exit that doesn't have these attributes. And I put at the top what I mentioned before, active involvement of a board. You know, most startups, they either have an advisory board that has big names on it who do absolutely nothing for the company, or they don't have an advisory board. And what's nice is to find an entrepreneur that reflects the fact that she doesn't know everything, and has gathered around her people that are willing to devote some time to her, who knows something about the arena in which she's operating. That kind of an advisory board is really helpful. And I've been on those advisory boards. And when you have an entrepreneur that reaches out and asks questions and seeks door opening opportunities, et cetera, it can be really valuable for the success of the company. We didn't mention anticipating additional rounds, but Colleen touched on it. This has to do with the waterfall, which we'll talk about, but it really is basically what happens to the investor's interest in the company as you go forward and raise additional capital, right? So if I own 100% of the company and I sell you 50% of it, now I own 50%. And then if I sell to some other person another 50%, then I own 25%, assuming I can get 25% from the first person I sold 50%. You with me? In other words, the entrepreneur's interest goes down, as can the investors. And we'll talk later about why that's important to you. It's important from, again, the investor's perspective and also the entrepreneur's perspective, because you don't want an entrepreneur that doesn't understand at the end of the day, after she raises all the capital she needs, she owns 1.7% of her company. Now, likewise, you don't want an angel investor who ends up with the same thing and gets out of the exit, gets $47 back. Not fun. And then, of course, do adequate due diligence, I'll say that. There's always a valuation discussion with the entrepreneur, because there's always an offer. Well, actually, there was one startup that didn't know what they wanted exactly, but normally 99.9% of the time, the investor or the entrepreneur has decided they need $1 million, let's say. They've calculated what they're going to do with the $1 million. They're going to hire certain staff. They're going to buy some equipment. They're going to file some patents, et cetera. And the entrepreneur, of course, thinks the company at that point is worth $1.5 billion. And so the angel investor always has this discussion with an entrepreneur back and forth about what the company is worth. Yeah. And it's always important that you understand, back to the discussion about perspectives, that it's not the angel investor's goal to drive that valuation down as low as you can get it. That's not what we do. Yeah. From the entrepreneur's perspective, you have to talk sense into the entrepreneur, because you have to dissuade the entrepreneur that their business is not worth $1.5 billion, but you have to understand it enough to give reasons why it's not. Yeah. And part of that sometimes is looking at a waterfall, looking at exit scenarios, which we'll look at a little bit later. So the discussion, now we'll talk a little bit more detail, a little bit more specifically about term sheets. And as I said, term sheets now are online. You can find term sheets all over the place. But basically what a term sheet is primarily is saying, you give me this amount of money and I will give you X. Yeah. And X usually these days, almost always these days, is equity or debt. Yeah. Everybody understands the difference between equity and debt, right? Equity is I buy a piece of the company. Debt is I loan the company money. Almost never is a company looking for pure debt. They're looking for convertible debt, and we'll talk about that in a moment, which converts to equity. So ultimately, the investor, whether she buys equity or she buys or invests in a convertible debt note, ends up owning a piece of the company. Then there are, beyond the basics, the fundamental issue that you found, that is found in every term sheet, you have preferred versus common shares if it's a corporation. By the way, most of the entities that we see now to invest in are called limited liability companies. Anybody not familiar with that concept? Yeah, limited liability companies now is the premier way in which startups structure themselves, primarily because a limited liability company it has the least strictures in terms of formation, in terms of operating agreement, et cetera. And when I say operating agreement, that's basically the agreement that dictates how internally, it's like bylaws in a corporation, dictates how the company operates. Almost all of the investments we've made over the 10 years have been in limited liability companies, and our own investment vehicle is a limited liability company. So it's important that at some point you find an operating agreement and read it. You can read Can's operating agreement, for instance, just to get a sense of what's in there and how they work. There are, as I said, convertible and participating debt. Convertible note is just what it sounds like. I'll give you the details in a moment, but it's an instrument that's carried on the books of the company as a loan. But it's never called, or almost never called. What happens is, under certain circumstances that are defined in the loan agreement, that note converts to equity. There are protected provisions, et cetera. We don't need to talk about those. There are prepayment prohibitions. If it's a convertible note, you don't want the money back. One of the things I caught in one of our deals was the convertible debt note had been taken off the internet somewhere, but then the entrepreneur or entrepreneur's counsel had added a provision that said, and the note may be prepaid at any time without penalty. And so you're thinking, well, wait a minute, why would I, give 10 grand and I get 10 grand back? And that's not what angel investing is all about, but that's a good reason, following on what Colleen said about reading the documents. Yeah. And there, the difficulty for angel investors who are not conversant with the typical convertible note, or not lawyers, or are unaccustomed to looking at these things, that provision might slip by you. You just might not catch it. So again, you need to read these documents carefully and think about what it means. That language is pretty obvious. This debt may be prepaid without penalty, period. That should be one of those red flags where you say, wait a minute, I made a loan and I get paid back and I get nothing from it? No chance. Most favored nation. Now this relates to the waterfall. Let's see if I can illustrate it without writing on the board. If I have 10% of a company. Let's say I've just bought 10% of a company for 10 grand. And then the entrepreneur is successful, hits a milestone, it goes out and raises another, let's say they raise $100,000, 10 times what I put in. And they're gonna sell another 50% of the company. So my interest in the company shrinks pretty dramatically. Think about that, right? 50% more of the company goes away and my interest gets smaller, right? Most favored nation just says, look, if you offer other equity or other debt, or you offer anything to the marketplace, then the first investor or whatever investor I am in the rank, I get an opportunity to buy the same amount proportional to what I invested in the first place. Most favored on the same terms. That's the notion of most favored nation. In other words, I can't be screwed out of the deal that I cut by virtue of the future deal. That's important because interestingly, a lot of entrepreneurs forget about the desperate straits they were in when you made the first investment. Later on, they're successful and they're not thinking about your 10 or 50 grand that got them over the hump. They're looking at the stars now. And so you got to be careful. You want to maintain your interest, even though at the beginning, it was kind of a small amount of money in comparison to what's being raised 3 years later.
Hey, Craig.
Yeah.
Is it also called pro rata rights?
Yeah. Yeah.
Does somebody
Well-
like pro rata rights?
Pro rata, but most favored nation expands on it and says, not only pro rata rights in terms of amounts, but also in terms of terms. The terms have to be the same as well. Board participation, we don't typically, well, two things, two comments. One, a corporation, and this goes back to what I said about the flexibility of an operating agreement in a limited liability company. In a corporation, you're required to have a board. Yeah, corporations must have boards. A limited liability company may have a board, but it doesn't have to. So it's one reason a limited liability company is easier. And by the way, an advisory board doesn't have to have any legal status at all. And so sometimes it's easier to get people to act as an advisor on an advisory board because they have no fiduciary obligation to the company. They sit on a corporate board. Now there's all sorts of fiduciary obligations, et cetera, et cetera. There's D&O insurance and all sorts of crazy stuff. So a lot of times an advisory board in a limited liability company is much easier to obtain. We don't take board participation. If you go to the VC level, most VCs at a certain level will insist on a board seat. But then there's other attributes of a VC investment that come along with that. That is restrictions on what can be done in the company without board approval, and that board member then gets a super vote. In other words, basically, the VC controls what can happen in major issues. Conditions precedent. I've got term sheet. One of the things we've done over the years is modify term sheets. So you look at it, you look at an angel investment possibility, and a startup has let's say a patent that is just, you think, fantastic. And we'll talk about intellectual property and the issue of patents. But let's say for the moment that you have a patent, but it's not been issued. And the company rises or falls on the ability of the company to obtain that patent issuance. So you might write a condition precedent, meaning I'll give you this money in the term sheet, Bob. I'll give you the money if this happens. Upon issuance of the patent, will trigger the investment, et cetera. So many times there's conditions precedent in that, and that way you can get a deal a little bit down the road and provide, for instance, an example out of my history is I was leading a deal. There was employment agreements with key scientists, 3 of them, but it was written under Connecticut law. And in Connecticut, you can have a non-compete or could then have a non-compete in an employment agreement forever. And I said, well, gee, that's interesting. A, your company's in Virginia, so it's questionable whether you can apply Connecticut law to those relationships anyway. But B, a non-compete forever in Virginia is illegal. So we wrote a condition precedent. We said, here's the employment agreements we're willing to accept attached to the term. Once they're signed, we'll invest. So sometimes you have the ability to actually get the crappy documents, if you will, or lack of documents in order with the vehicle of the term sheet by writing conditions into the term sheet that dictate what it is that you need in order to invest. Pre-money, post-money, we don't need to know about. Okay, now we've mentioned now a couple of times waterfall, and I'm going to show an example in a moment, but the waterfall is important for both the angel investor and the entrepreneur, because as I said earlier, it shows both parties where you end up upon exit. Now, there's a bunch of assumptions that go into it. These are the elements of a waterfall. These are the things that would be shown on a waterfall. They have to include everything that would affect the outcome upon exit. Yeah. And if you ask an entrepreneur, do you have a waterfall? 75% of them, 25% won't know what you're talking about. 75% of them will not have one. And it's incumbent upon us as the investors, if you're on the investor side, if you're on the entrepreneur, you should do it. It's incumbent upon the angels to have it done, to either have the entrepreneur do it or to do it. I've done it for the entrepreneurs, just so that I can show the entrepreneur and say, look, Sally, you know, in year 4, if you actually raise this kind of money, if your thinking is correct, you're going to end up with 1.6% of the company. Do you really want to do it that way? And then you rethink. So the waterfall is not just a static reflection of where you're going, because obviously nobody knows when the exit's going to occur, how much money. We're making assumptions, but based on the entrepreneur's assumptions, you can show what the angel is going to get and what the entrepreneur is going to get, because every entrepreneur, I guarantee you, has an exit strategy, right? And the exit strategy is always multiple of $1 billion, whatever it is, and it's always in 5 years. Take that into account. So here's a cap table, and just this is a simple capitalization table, just showing what happens in 2 rounds. So not to get into the weeds on this, but here's your 2 entrepreneurs, and they were generous enough to give their employees some stock. So that's what the cap chart looks on day 1. There's no investors on day 1. It's just the entrepreneur and the startup team. Yeah. Then they raise $500,000. They raise, $750,000, right? And they give away 20% of the company. And so that reduces everybody's interest in the company by 20%, right? Then they go out in what's called an A round. And by the way, if you've ever talked to anybody about seed round or A round or C round, it doesn't mean anything. These are terms that are thrown around willy-nilly. We've had seed rounds that were $2 million. We've had A rounds that were $12 million. So
Don't forget pre-seed.
and pre-seed and friends and family, and friends and family round is whatever you can extricate out of your friends and family. That's the amount you get. And then the A round here is $3 million. So now the entrepreneurs are down to 32 and 16. Just a simple example, just to burn in the brain what it looks like as additional rounds are raised. And you can imagine if this goes on and the next round is $10 million, all of a sudden the founder's interest in the company gets smaller and smaller, and that may be okay. You know, it's great. I'd rather have 1% of a $100 billion company than 90% of a $12 company, right? But at some point you need to understand those things. And also importantly, going back to trying to figure out whether this entrepreneur is the jockey you want to invest in, it's how the entrepreneur responds. Yeah. You're asking questions. Well, what do you think? What are you going to do with $3 million? Have you projected that? Why do you need $3 million? And we'll get into forecasting a little bit later, but the waterfall is or the cap table is a good place to start in terms of developing the kind of data you need to analyze the entrepreneur. So liquidation preferences, let's talk. And again, we're talking about things that would appear in a waterfall, which is an expanded cap chart, if you will. Yeah. It's a cap chart like I showed you, but it's got more lines, it's got more raises and more things on it, warrants, dividends, etc. It's also got liquidation preferences, and I'm going to show you the effect of a liquidation preference. These used to be West Coast deal terms, yeah? He did a deal in Silicon Valley, the big guys on the block, they had 2x or sometimes a 3x they call it liquid preference. Yeah, liquidation preference. And what that means, I'll show you. So here's a waterfall, yeah. Similar to what I showed you in the beginning. Here's our entrepreneurs in their seed round, yeah. This is just a reflection of what we did before. Now they have an exit. They're lucky, yeah. After they did the A round, somebody bought them for 10 million bucks. Okay. If there's no liquidation preference, then what happens to the $10 million? It simply gets split up according to the percentages on the cap table, right? Simple stuff. If there's a 2x non-participating liquidation preference, now what that means is once the investor gets 2x is always, X is always what was invested, right? 2x is twice that. And if it's non-participating, that's it. So they invested 3 million bucks. 2x is 6 million. That's all they get. Yeah. And so the entrepreneurs got 1.9 million in the first one with no liquidation preference. The guys got 3.2 and 1.6 million respectively. With a 2x liquidation, obviously that reduces the sum of money to be distributed. They got not quite half, but significantly less. You see how much money a liquidation preference takes out of the pot. If there's a participating liquidation preference, what that means is the investor gets 2x first, and then the pot is split up according to the percentages on the cap table. So what happens is this investor ends up with 7.3 million bucks, and the investor goes from 3.2 to 1.28. Now, that's not necessarily a disaster. It's just something that should be understood. Yeah. Maybe the investor, maybe the entrepreneur is really happy with 1.28 million bucks. Yeah.
So for seed investor 2, on the non-participation 2x exit, what do they end up with 266,000 instead of doubling? Does the seed investor not count in the doubling? You see where there's the 6 million bucks for the A investor? Right above that is the 266,000.
Yeah, what I'm assuming is that the $10 million investor, the $3 million investor is the one with the lick preference. The first investor has no lick preference. Okay. Now that's a good point, because imagine now that the first investor also had a 2x lick preference. Now the pot gets smaller and smaller. Now, again, that doesn't mean that they see liquidation preference and you go, oh, no, I can't do that. Yeah, it might be fine. Yeah. If this number were $20 million and the investor made 2.5 million bucks, maybe the entrepreneur is quite happy, right? So it's not necessarily a negative or a deal killer, but it's something to be aware of. That's all. Rebecca.
So I'm gonna share a story that I don't like to share, but this is the place to share it. Which my husband and I went in on a deal. It was others at camp weren't interested. We did it on the side. We just had an exit not too long ago. And then what happened was the company sold to another business, but in the interim, we had made our investment and then a fund came in and they made an investment. We did not write along on that fund. They got 2x return. So, and it was an asset sale. They didn't sell the whole company. They basically sold the assets and then they gave the people who worked there a nice contract for a period of time. So there wasn't much left. So we essentially broke even on that deal. Right? Because we didn't continue. We didn't participate in the next round. And when they negotiated the 2x, we weren't in on that. So as the angels who just did the early investment, we were not in a good position. So it's important to consider when you're making an investment, what additional money are you expecting that company is going to need? Will there be follow-on rounds and can you participate in those rounds?
Absolutely. So two good things to note in there. One, what we talked about earlier, most favored nation. provisions. Hopefully they were in there and you have an opportunity to invest in a deal where the terms provide for 2x. But the other point in there is maybe you don't have the capital at that point or the will, right? So you always have to consider that making a seed round investment may not be the last hurrah. And it almost never is. There's almost, if the company's going to be successful, it's almost a sure thing. They're not going to be successful or exit based on seed capital. And they're going to go out for another round or maybe two. Therefore, the most favored nation provision is important because as the money gets bigger, they go to bigger funds and those funds will drive deal terms like the ones I just described.
Somebody online would like us to talk about what the minimum investment is by hand and what is considered too small.
Well, we recently had a board meeting. We decided that if there's not 100 grand being invested by CAN, we probably will allow the investors to do it individually. The caveat to that is it's really an administrative and a cost issue. So I just did one with 50 grand investment, but we required the investors to kick in another $600 each so that we had $3,000 to cover 6 or 7 or 8 years of administrative costs. They're small, but they're.
There's a lot of people that don't know anything about CAN, so they don't know that we set up an LLC.
Yeah, I was gonna get to that
Okay,
at the
very good.
end, if that's all right.
Sure.
Can I ask one question on the,
Sure.
so for the folks that come in on the seed round, sounds like what Rebecca was sharing, you know, if you're not in a position either because you can't financially or you don't want to, for whatever reason, to participate in the follow-on round, wouldn't that make it much riskier to be one of the seed people? If you're not saying I'm in a position to follow on, in other words, be ready to follow on or be ready to be in your scenario?
It would be, and that's why you need to look at a waterfall and feel comfortable with the assumptions that are being made, which is really difficult. I mean, we're all talking about the future, somewhere down the road, you know? So yes, you're gonna be diluted. Yeah, you never, I think I negotiated one deal before CAN. I did this a little bit myself before CAN. I negotiated one deal where I agreed with the entrepreneur that I could not be diluted. And then I felt bad about that because it was really obnoxious. I was young and stupid, but you know, you learn. So I didn't do that anymore. But that's the only
It's
way.
nice of you to admit that.
Yeah, I've been admitting my stupidity for decades, so it's not.
No
hard.
question.
Yeah, sure.
There been situations where someone has been diluted all the way down to nothing.
Oh, yeah.
Sure.
You're lucky
Sure.
to get your money back.
Yeah, as,
Even on a successful ISIN, right? Yeah, sure, yeah.
as I said earlier, you know, if you're interested in this, in this arena, investing, you get, it's a risk. It's a big risk. Yeah. And somebody said 1 in 10, it's probably 1 in 25 or 1 in 30 that are big hits. And big hit is 2x or 3x or 16x. Yeah, we've seen one big exit. But and a small exit, you know, we don't typically, you don't wait around and go, oh, 1 in 10 is gonna hit 20x.
Can I just chime in? So,
Sure.
you know, as an investor, as you're considering what deals you're gonna get in, this is an important thing to think about, right? If you are looking at that deal and it's pretty clear that they're gonna need multiple raises before they get to profitability or to the point where you might see some kind of exit, that might not be the deal for you. If you don't have the interest, capacity, whatever it is to keep going, right? You may want to look at a different type of deal. So it is very personal for an investor to make these decisions about what is going to be in your portfolio, what works for you.
And also the other side of that coin is, of course, we do make follow-on rounds. I mean, CAN has made 50 some follow-on rounds
More than
or more than that. So that's very customary that the entrepreneur comes back to the group that's already invested in the entrepreneur and says, now I need 500 grand. And many times we'll invest again because usually the entrepreneur is coming back. They have something good to say. they've hit a milestone, they've done something good, they've expanded the market, products out there, whatever it is. And that entices us to invest additional capital because now after 2 or 3 or sometimes 4 years out, you can look back, look at the projections, which we're going to forecasting, which we're going to talk about in a moment, and see that the entrepreneur was doing things right. Yeah. Maybe delayed, it's always delayed, but usually doing things right. Yeah.
No, you can't go.
What's that?
I know you gotta move forward.
Yeah, sure.
And you all follow-ons, have you simply maintained your equity stake or have you increased it?
Usually maintained it, sometimes it rarely increased it. Rarely increased it. Because the amounts increase, I mean, we've invested over $1 million in a company or two. But that would be a lot of money for Ken to invest in one deal. Usually it's $150,000-200,000, then a follow-on round might raise another $100,000. But it just depends on the deal. It really depends on what's going on with that company, how much progress that company can show. On the other hand, you have companies that come back to you and go, geez, I ran out of money and I'm about to shut the door. Can you help me out? And then it's a different deliberation. Then it's okay, but where are you in terms of what you said you could do? Are the assumptions being proven out? How far behind your revenue stream are you? Why are the costs? And, so sometimes I've invested personally in companies that were struggling like that and helped them over the hump, and they're doing well now. Not that would, but we'll see. You never know, right? So now we know what a waterfall is all about. Now, convertible notes. This is the instrument that on the East Coast anyway is being used most frequently. I say that because we'll get to it, these instruments called safes are a West Coast invention that are now creeping into our East Coast ecosystem, and I can't stand them, but that's just my personal prejudice. But a convertible debt is what we've seen most of, and a convertible debt is the following. As I said earlier, it's a loan. So number one, it avoids a valuation discussion. That whole discussion that I described earlier about, your company's, you got a dog, an idea, and a cup of coffee, and your company's not worth $1 billion. You don't need that discussion when you're just loaning money, because there's a conversion factor and a discount. So what you're saying is, look, I'll give you $100,000 and I'm going to get an 80% discount to a financing event. In other words, somebody else is going to come along and say, okay, your company's worth $10 million and I'm going to convert my $100,000 at a 20% discount. So my money's worth that much more. So I'm going to get 100, whatever that works out to be, 120 grand. Plus it carries an interest rate, typically somewhere between these days 6 and 8%. So the interest accrues, and when it converts, I've got more than 100 grand to convert into that. And that sets the tone or sets the floor for not having to discuss the valuation. In other words, that financing round down the road somewhere is going to set the value. And qualified financing is the term that you'll see. Again, if you're interested, look these documents up online and just read them. Yeah, they're boring legalese, but read through them, and if you know basically what the terms are, you'll understand it. Qualified financing is an agreed upon amount. It usually says qualified financing is defined as $3 million raised from a third-party equity, blah, blah. And that is the trigger. Once that money is raised, that triggers the conversion of the debt to equity. Now, in Virginia, we have 3-year terms on convertible debt because there are tax advantages to doing that. But many times the note will come due 3 years in, and then what do? Well, we don't call the note because we don't want our money back unless the company's going belly up. And that I've only seen in one case where we actually called the note. Otherwise, you just renegotiate the terms of the note. Then you let it run for another year or two or whatever is necessary. Here's an example of what happens. Yeah, I lent $200,000. The interest rate was 10%, a discount of 15%. Took two years to close. The qualified financing amount was set at $3 million. The pre-money valuation, that means the company was valued at $6 million. And the investor was putting 3 million in. So I didn't go into it before. So post money is what? Pre-money 6, investors putting 3 in. Post money is what? 9, exactly. Post money valuation is 9. So the qualified financing is 33% of that. That understandable. The interest accrued is $40,000. The conversion amount is 240 grand. So the discounted conversion is $282,353. Don't worry about the calculation. The point is that my 200 grand loan morphed into an equity interest in the company of $282,000. That's how a convertible debt works. And the lender had nothing to do with setting the post or pre-money valuation. That was done by some third party, typically. Yeah.
Right.
Yeah.
On you made the comment about not having the note.
Yeah.
And we often do have a discussion with them and then negotiate. Can you talk about when you would just flip it into equity? Like, you know, what are the options when you get to that period, and why would you choose different options as the deal leader, as the investment group?
I guess the first reason that occurs to me, if I want to, so what I said before is you renegotiate the note. As Rebecca's suggesting, you don't have to do that. You can convert, if the entrepreneur is willing, you can convert that note to equity at that point. Then it's just a negotiation, right? Because there's no qualified financing, there's no post-money valuation, there's no pre-money valuation, other than back to the valuation discussion. Now you're back talking, slogging through, no, it's not worth $1 billion, yes, it is, no, etc. But if the entrepreneur is willing, you can say, look, let's just agree, I'll convert my note to 8% of your equity. How about that? And whether I do that or not is based in part on a whole bunch of things. One that occurs to me is if the entrepreneur is going for bank financing and doesn't want debt on its balance sheet, it's good to get debt off its balance sheet. B, if I get debt off the balance sheet and I could show a lender, or for that matter, another investor, that I've got an equity investor that is Charlottesville Angel Network, that's also valuable in terms of presenting my company as a solid company. Whether I want equity, equity gives me a whole lot less power. If I have a debt instrument, I have the ability to force a negotiation, which is sometimes helpful. Maybe something's going on that I don't like, or a deal's been executed that I'd like to see change, then the loan gives me the ability to leverage the outstanding debt and get something that I might not otherwise get. So it's really a individual deal-based decision as to whether or not I would convert. But yeah, we've done that. Just said, okay, let's convert it to equity. It stops the clock running too. That 4% or 6% doesn't continue to accumulate, because that can run into a lot of money.
Yeah, so because we see from the entrepreneur perspective, if they're like they're holding on to these notes for 8 years and they're just accumulating interest, like, hey, just convert those suckers.
Yeah. 8% on $500,000 for 8 years is a lot of money.
Yeah.
Absolutely. Yeah. Safe agreement. I'm going to talk about this briefly because I don't like these things. So safe agreement. Huh?
Tell us how you really feel.
I don't know why people do these things. I mean, I know why. The entrepreneurs love them because there's no debt, number one. There's no due date, number two. There's no interest accruing, number three. There's sometimes a liquidation preference. There's sometimes a discount. And they say, oh, we did this because, and I understand Silicon Valley does it because when they have these entrepreneurs fairs where they have 400 entrepreneurs showing and 50 of them get deals, they just throw these safe documents in front of them and sign them. Because out there, if you're managing, $6 billion in a fund, you don't care much about 30 grand that you're investing in 27 different companies. So everything's standardized, they're quick. The entrepreneurs love them, so the entrepreneur is not going to give you any resistance. In the real world, if you're using safes, out here and you're not a $6 billion fund, then it's like a convertible debt instrument or like any other instrument. There's a whole bunch of terms that could be negotiated. So now you're back to negotiating the terms in a safe agreement. Yeah, whether there's a liquidation preference, whether there could be interest, there could be a maturity date, there could be a qualified, so the safe agreement becomes not a simple, that's where it comes from, simple agreement for future, but a pain in the ass agreement for future equity. I'm gonna rename them, pain in the PAAFE. Kidding aside, they're great for entrepreneurs. If as an entrepreneur, you can get one, that's what you ought to do. I should say that from an angel perspective, I don't like them. And the first thing I would do is say, I really don't want to do a safe agreement with you. Let's do this. And I might offer convertible debt, or I might offer a safe agreement with some modified terms. A safe agreement is also dangerous because there is no maturity date. So unlike a convertible debt situation, you never have an opportunity to get anything out of the entrepreneur. You have no leverage, right? The entrepreneur has you and your money, so to speak, but you have no leverage going down, and it might never convert.
Right.
Yeah.
We've done a number of deals that are safe, so the deal needs are, okay with that.
Yeah.
What if we really want to invest, the family really wants to invest, it's offered as a safe and other people have already invested in the safe. Is there any way for them mid-round to convert it to something other than a safe?
Yeah, I mean, you could always issue another instrument, that would be, it would be a pain in the neck, and I wouldn't ask the entrepreneur to do that.
Yeah. I didn't think
If they're already, and that's half the time, that's where they are, we've already done the documents and
Right.
we've got 300 grand already
Yeah.
raised on
And
those terms.
That's why we ultimately, I think, invested in safe.
Sure.
Because we don't.
Sure.
don't need it.
I think most of our safes that we've invested in are actually convertible notes. They've got all kinds of terms. And
That's
they
because Craig
read
got his
like-
hands on it.
Yeah.
They might have been my
They're-
deals.
You're
Yeah.
called to save, but they're not actually.
That's true, right? They're very manipulative.
They're-
Calling them a safe, they're not gonna do a simple agreement for future equity.
Because they get negotiated. The entrepreneur pulled it down off the internet and came and said, here's what I want to do. And the investor looked at it and go, I'm not doing that. If you want my money, I need these provisions in. So then you negotiate the thing. And all of a sudden, it's no longer simple. It's complicated. It's a cake.
It's a PETA safe.
PETA safe.
It's. But again, all kidding aside, if I'm the entrepreneur, I want to save. Great for me as an entrepreneur. I just don't like them as investors. Okay, valuation and risk. This is a point that should be obvious now by virtue of our discussion, and that is that if you don't do your due diligence up front to the extent that you can do it, you really increase the risk, but you can't understandably eliminate risk in any investment situation. And that's why we have this red flag approach that I mentioned already. And so we look at things that can affect the valuation of the company, right? And by the way, Can and every other entity on the face of the planet uses the due diligence checklist that we send out to the entrepreneur. I sent it out at Fulbright when I was a corporate lawyer to, billion-dollar publicly traded companies, and they all look pretty much the same thing. You're all looking for the same data. Big public companies have data rooms. They send you 6 million pieces of paper. Startups have 6 pieces of paper, but the requests are the same. So you have a due diligence checklist, and it asks about corporate organization, whether the company's in good standing, whether it has the appropriate licenses for what it's doing, whoever is signing the things has the authority to do it. And by the way, this sounds a bit too technical, too legal. But if you've got a document that you're negotiating and you negotiate a purchase agreement for equity and somebody signs it and they don't have the authority to sign it, you might have difficulty later on. So that's what I mean by authority. Is it the president of the company? Did they actually have a board meeting and establish the company properly? Is there a manager of the limited liability company who authorized to sign such things? That's what I mean by authority. Financial statements, to the extent that they exist, if they're tax returns, they ought to produce them. That's part of our due diligence checklist is produce your financial statements, produce your tax returns if they filed any. Financial statements, real and personal property, do they own any? Accounts receivable, inventories, basic stuff that you would think about if you were investing in any corporation. Employees, benefits and contracts. Now, when I start talking about contracts, it's important to think about the kinds of contracts that ought to exist. Yeah. The difficulty in doing due diligence here is it's not only what does exist, but also what you should want to see. So for instance, many entrepreneurs, many startups are based upon an invention, right? Somebody thought up something dramatic. They've got 47 patents on it, and it's going to change the world, right? It's going to pull energy out of thin air, for instance. And the patents, the entrepreneur, the inventor and his partner are the two founders. And if in that scenario, there's no inventions agreement, yeah, if there's no agreement that the inventions that that partner produces belong to the startup, then you've got nothing potentially. Yeah. So my point in saying that is just to illustrate there might be a document, but there also in due diligence, you're looking for documents that should be there that don't exist. So you got to be thinking through issues like that, or non-competes is a good example as well. Even though the FTC violated its authority and has no mandate to do it, they just issued a ruling that said non-competes are illegal. I think that's going to be overturned, but nevertheless, non-competes should be important because if you have a key scientist who's the key to your company, she's working for you, you should have an employment agreement with her, part of which should be a non-compete. She shouldn't be able to leave your company and go 6 miles down the street, build a company and destroy you. That's what traditionally a non-compete was for. They don't exist in California. They were made illegal in California decades ago, but that's just California. And so other things that affect valuation, compliance, are there compliance issues? Are there environmental issues? Are they building a company that is using environmentally hazardous waste, for instance? Are they dealing with that properly? Intellectual property we'll get to. Securities laws, probably not so much. They're not filing securities filings. You do want to know how they've raised money though. If I would say one thing that you look at in startups, is there a public offering of any sort? Have they gone on the internet and said, hey guys, we're raising money out here, et cetera? A public offering triggers all sorts of federal and state regulation, securities regulations. You want to be careful of that. You don't want to participate. And some entrepreneurs just not aware of it. And they go out and violate the laws left and right. So having said this about valuation risk, then I inserted this slide just to show you, this is an old CB Insights analysis of the reasons, top 20 reasons that startups fail. And this relates, think about this in the context of trying to do due diligence. What do I need to find out? And I won't take the time to go through all of them, but I've summarized them in the next slide, and you'll see why this is important and why the due diligence aspects of investing in startups turn, in my view, on the entrepreneur himself. So if I summarized it, you can go back and look at these: ran out of cash, not the right team, poor marketing, ignored customers, lose focus, disharmony on the team, pivot gone bad, lack of passion, burnout, failure to pivot. All of those relate to not the right team. Yeah. So it really is interesting how many of those items on that list of 20 relate to the entrepreneurs themselves. That's why this difficult process of analyzing the jockey, so to speak, is that entrepreneur the right person to be running this business? And of course, there's no objective way to determine that. We're trying to figure that out by virtue of our relatively brief interaction with the entrepreneur, right? Second is ran out of cash. That has to do with marketing, understanding the marketplace, understanding the assumptions that the entrepreneur is making with respect to what it costs to build it, what it costs to sell it, et cetera. And no market need. I mean, the big thing about the product is there a market need? We've seen some unbelievably interesting products with great entrepreneurs, but in order to get the market to need it, there was an educational component that was vast. In other words, if you spent an hour with the entrepreneur and played with the product, you were gonna buy it immediately. But you had to spend the hour. And then the question is, how in the heck do you educate the public? You never get anybody's attention for an hour, and that becomes really difficult and a huge impediment to success. So here are the elements of the success. The timing, just what I just said. Does the market need to be educated? That's a big one. It's one that's sort of buried a lot of times in startups. You don't get there because you get excited about the product, you get excited. We've had doctors come and tell us about a new product that they developed and what a wonderful thing it is, et cetera. But then the issue of actually going out in the world and educating 27,000 doctors in that specialty to using this thing was a wholly different item that had never been thought about. And by the way, costs big bucks. Yeah. What problem does it solve? You've seen that. If you watch Shark Tank, that's sort of the basic question. What problem is out there? What are you solving? What problem are you solving with this? And then the business model and the funding. We're going to get to the forecasting here real quick. Business model is always based upon the entrepreneur's passion. I've never looked at a 5-year projection of any company in the, I don't know, several thousand companies I've looked at over my career that a forecast had been right for a year, let alone 5 years, including publicly traded companies. Forecasts are forecasts. They're fake. They're based on assumptions. They're carrying assumptions forward and projecting them. And entrepreneurs do it, how shall I say, egregiously, not because they're trying to trick anybody. They do it because of their passion. They go, oh, look at that. If I take this Excel spreadsheet and have it multiply, have it increase by 47% each year, in the 5th year, I generate $60 billion. And in a moment, we'll see why we can look at the team more closely based upon the forecasting that they're doing. Here's the market, just to outline in more detail the market. These should be pretty obvious. Pivot is interesting. Everybody understand what pivot means? Pivot means that I've gone down this road. I'm going to sell to veterinarians in Georgia. Well, that didn't work, but then I figured out how I could sell on the internet to the entire nation. Now that's a silly example of a pivot, but that's what we call a pivot, where you change either the product or change the direction, the consumer. Maybe you go from B2B to B to consumer or vice versa. So pivoting is also an entrepreneurial skill that is difficult to glean from an interview with an entrepreneur, but you might glean it from her experience. You know, what did you do for the last 10 years? Well, I had 3 companies, I did this, and then I moved, and so sometimes you get a handle on that, but it can be really important because most companies, no, not most, half the companies we see pivot in some fashion or another. If the pivot is only the fact that their projections stunk and they had to redo them. Yeah. And when I say that, I mean that the projection of revenue and EBITDA was wrong. And it took longer, it took 2 years longer to get to break even than they had projected. And that's very typical. And it's based, again, in a non-nefarious way. It's based on passion of the entrepreneur. The team. Here we go. I'm just naming again these elements from the list of 20. Not the right team. Well, what's the right team? We don't know. It depends on the individual company. Too many, too few. There's an interesting question. What's the right number of entrepreneurs to have? Usually we see 2, right? But sometimes you see 1, sometimes you see 5. Usually it's 2. Are the 2 business savvy and product savvy? In other words, we see scientists come out of UVA who are really product savvy and have no clue how to run a business or how to manage people. You can have a business savvy person who worked as CFO at BMW, but doesn't have a clue about how to run people, how to encourage people, how to get people to do great work. So the right team is a component, or is made up of components of different skills, usually. No one person has all of the skills that you need to be a successful startup, so you need many. If you need more than one, if there are many, then you run into the issue of who makes decisions. That's always an interesting question. When I sit down with multiple entrepreneurs and start talking, I ask those kinds of questions. Well, what if you need to raise more money? Who decides? Do you all have a vote? You know, what if you don't like George next year? And that's never thought. When you ask a startup, you know, what happens if you need to get rid of one of your partners? Nobody ever thought of that. And that can be a devastating occurrence for a startup. You have a startup that runs into that problem where the entrepreneurs are loggerheads, the investor is going to get screwed because the company's going to go away. Yeah.
What do you recommend founders get their founder agreement document? And what are the most important things you think should be in a founder agreement?
If the agreement is the operating agreement in a limited liability company, then there ought to be a provision, there ought to be a buyout provision. In other words, in the event of X happening, event of major decisions, inability to make major, you can always go to court and ask a judge, and then 2 years later you get a decision. So in the meantime, even if you can't put it in the operating agreement, because sometimes that's just difficult because the entrepreneur wants to get on with raising money and producing the product, and doesn't want to mess with lawyers, and it's expensive. You know, you sit down with a lawyer for 10 hours to figure that out, because believe me, there would be a lot of passions. Both partners would be wanting something, and neither partner will want to go, and neither of them will want to think about it. So you're talking about a lot of time and effort spent, but I always ask the question because I think it's important that they think about it. You know, you're good buddies now, you've been best of friends, you went to elementary school together and grew up together, and you married sisters, but now you're gonna fight, and how are you gonna get rid of one of those partners? I've seen companies destroy, I've seen big companies destroyed on family infighting. So somehow that topic ought to be raised. And if nothing else, at least you can get a sense of the entrepreneur by asking those kind of questions. At least you get a sense of how the entrepreneur would react to such a thing. Disharmony is what we're talking about. Lack of passion. Lack of passion and burnout is many times related to the waterfall. So you start with this massive amount of passion. You own a company, you forecast it to be $1 billion company, and you start raising money, and 3.5, 4 years in, you look at the cap chart, the waterfall, and you go, oh, I don't own a lot of this company anymore, and now I've got this jerk from Silicon Valley sitting on my board dictating what I can do. So I don't have any freedom, and B, I don't own much of my company, and now I have a lack of passion. My passion goes away. So that's one of the reasons that early on you talk about the waterfall and you talk about these forecasts. So you make sure that at least from the financial side and the control side, the entrepreneur feels that he or she is being supported rather than crushed. Yeah.
Hey, Craig,
Yeah.
I just want to emphasize something that you just said.
Yeah.
Because on the lack of passion, I think that's a really good one to hone in on the due diligence with the founder, because we've got a number of them that they're running out of steam, right? They went through COVID, they suffered beyond what they thought they were going to suffer, and they're getting really tired. So knowing, as we all know, you know, do any kind of due diligence or evaluate businesses, right? Things go wrong. There's 1,000 ways to die. There's 1,000 problems you're going to have. So having those conversations with the entrepreneurs around their staying power, and, you know, because it's not just about the short-term passion. What if this takes 10 years or 12 years? Because 5 isn't the norm anymore, but a lot of folks walk into it thinking, oh yeah, I'm gonna flip this sucker in 2 years and I'm good. Well, what if that's not the case? Can you see yourself staying with it right? And what will allow you to stay with it, and what do you need personally to keep going? So digging in with the entrepreneur on their personal needs, not just the business needs, is really important when you're doing due diligence.
Absolutely. It's a good point, and it's another touchstone that you can glean information about the entrepreneur. How do they react to that? It's a good question to ask. I always, you try to ask hard questions, yeah, because that's how you get good responses from the entrepreneur.
Somebody wants to know on the online, how do you feel, how does Can feel about solo founders?
Less enthusiastic than multiple founders.
Is 2 the magic number?
No, it's not the magic number. It depends on what's going on. Is it a product, an invention? And is the scientist aboard? And does the scientist have business savvy? Or do they need a business savvy person? We've actually, as you know, we've actually put business people together with the scientist in order to overcome that hurdle. There's no magic number. Nothing that we've been talking about is written in stone. I mean, I'll even do a safe, which ought to illustrate how dynamic. the
That was
world is.
just recorded.
I should have said under certain circumstances. And the other thing that's on here, it's interesting, is what I also mentioned earlier, and that's failure to utilize the network, the advisors. You know, an entrepreneur that becomes aware that we've got whatever 70 members plus a university full of really intelligent people who's not willing to call on that well of knowledge and information, is just cutting herself off from possible success. And all it takes in some situations is opening a door. Hey, you know, Sally, call Mr. So-and-so at Bosch. He's looking for exactly that, and Bosch Finance buys you. Boom. Yeah. And not being aware of it and not being willing to take on that advice is just short-sighted. Cash, ran out of cash. This has to do again with forecasting. In other words, we should have more knowledge. We as investors, or you as business people, to the extent that you are, should have more knowledge about what it takes to run a business or where businesses spend money. In other words, when we look at forecasting, we can say, well, you're making an assumption that you can increase your sales by 1,000% over 3 years. How many salespeople does that take? Yeah. How are you going to cover? You're talking about national coverage and salespeople on the ground. What do you pay them? What's their commission? How much does that cost? Is that in your forecast? Those kinds of things are important. And if they're not thought about and you don't get immediate answers on that when you're looking at the entrepreneur, you don't get immediate answers, then an entrepreneur hasn't thought about that. And that gives me some concern about the entrepreneur. Then I realize that the forecasting is just Excel spreadsheeting rather than really thinking about the assumptions that go into a successful business. So here's the framework for due diligence. I'm just going to pull a couple of these issues out and talk about them in a bit more detail. Remember that we're not trying to solve due diligence or corporate issues. What we're trying to do is identify red flag issues so that your due diligence process stops, so to speak, and that issue is put forth to someone who knows more than you about it. Many times they're legal issues, unfortunately, so they come across my desk. But you guys can understand. Oops. So we want to understand the company. We want to understand the market. We go outside the company all the time. Yep. One of our efforts is to go beyond what the company's doing, identify the market in which the company is trying to sell its product, assuming it's a product or service, identify what competitors are out there. The entrepreneurs all now know what's supposed to be in a PowerPoint presentation. Everybody does the same PowerPoint presentation, except one we recently had didn't have a forecast. So after I got back up off the floor, I asked about, and they had a forecast, they just didn't put it in the PowerPoint for some unknown reason. But the point is that everybody has the market in their projection, in their forecast. They have a slide that shows who their main competitors are. And they'll have a slide that shows what their main competitors are doing and why their product is the best ever. And then what we do is we go beyond that. And many times we'll find other competitors that are not mentioned. Again, I don't know if it's intentional or not, it doesn't matter, but we try to identify the entire market of competition so that we understand it, yeah? Because the entrepreneur will say, oh, it's a $150 billion industry, right? And then we try to figure out what it really is. Yeah, it's a niche, it's a portion of that and it's regional and et cetera. We try to figure out what the market is because the entrepreneur's revenue stream is usually based on getting a piece. Look, if it's a $150 billion market, all I need is 0.7% of that market. And I've got a $45 billion, whatever that is, $90 billion company. Those are always wrong assumptions. So we need to be aware of the company's projected market. We need to analyze whether it's accurate or not. Again, management team crops up all the time. The idea, the product, the intellectual property. Now, I said I would say something about patents. So we have some companies that have 27 or more patents. We have some companies that have one patent. One patent is worthless. Yeah. Let's not fool ourselves. In the real world of competition, if you are competing with a product that is going to harm a successful established company's market share, they are going to either crush you or they're going to buy you. So it could be a good thing if you've got a good enough foothold in their marketplace. That business may say, oh, we don't need to litigate this, let's just buy it. If it's a crappy patent, though, then they will simply crush you. And so what that boils down to is a difficult thing for investors and frankly for entrepreneurs to understand. A, you need great legal counsel. Yeah, the patent rises or falls on the ability of counsel to articulate claims in a document that set it apart from anything else in the world. If that can't be done, it can't be done properly, a patent is worthless. Issued patents, the fact that a patent is issued means nothing. It just means some guy sitting in Washington looked at the piece of paper and said, oh, okay, this looks good. I mean, obviously they do more than that, but the point is that the issuance of a patent is not your guarantee or not the entrepreneur's guarantee that that product is protected. So let's understand that. Number two, or B, I guess, I said A, now B. B, the ability to utilize the patent is dependent upon the entrepreneur's understanding of other patents in that universe. So if there's a patent, that means that the entrepreneur has patent counsel. And then sometimes I've asked the entrepreneur to give me permission to talk to patent counsel. And that's an interesting conversation because then you can simply ask, hey, Alice, what did you look at? Did you look at, I see these 4 patents cited. So patents cite other patents in the arena in which it's patented. What did you look at? Did you look at this? And how did you, you get a basic idea. I'm not talking about trying to do a patent analysis. I'm talking about getting a basic understanding. And frankly, when I do it, I want to know who the patent counsel is. So once in a while, I have a former partner who now runs a firm of patent litigators. I don't know, about 200 lawyers that do nothing but litigate. And once in a while, I'll send him a patent or 2 or 5, and I'll say, David, he doesn't give me an opinion because that costs $25,000 or $30,000. But I say, David, look at these. Do you think they're well written? And he'll look at them and he'll go, oh yeah, I know that firm. That guy, he's really good. And I like the way the claims are formulated well, they're strong, period. That doesn't tell you whether or not the patent is defensible, but it gives you a better understanding if A, the entrepreneurs selected good counsel, and B, whether there's some likelihood that that patent is gonna mean something in the future. So, yeah, go ahead.
So, if not, I think one of the misconceptions is that for non-law people is that all patents are equal, but it sounds like they're highly they vary highly in their, I guess, worthiness.
Wildly. Yeah. Absolutely. Yeah,
Can I just add a C to your thing? Is
sure.
yeah, that not all patents are equal, and the way that you hate saves, I hate design patents.
Yeah, yeah.
Design versus utility patent.
Yeah, explain that if you would.
Design patent essentially covers like the. Also literally the way something might have been like drawn out and. Is maybe even constructed, but not the function of the thing. Design patents are possibly easy to get around. You just change one part of the design and you're no longer competing with that patent versus the functionality is much harder to get around. And so the number of founders that will say, hey, we have patent, ask if it is a design or utility patent, because probably 5 times out of 10, it's going to be a design patent. And you're like, congratulations. But from my perspective, that's not, you're not protecting my risk.
Absolutely.
And a patent will never cover everything that can be covered with something. The US Patent and Trademark Office is gonna say, okay, you have 12 claims in here, we're gonna give you 3. So which 3 do you want? You know, or these are the 3 we're going to grant you. And then you can do a divided all patent. There's all kinds of patent strategies, and that's why you are a really good patent strategist to wrap it all up so that every use claim, every possible iteration of your design or your product or your chemical or your molecule is all wrapped up in other patents. And so it gets to a place where nobody can do anything with your concept, your product.
I was just recently doing due diligence for a company that had like 25 patents. And so I started really like trying to understand more about it. And one of the things that people don't really talk about is that even though you have patents as a small company, you may not even have the resources to defend it should somebody infringe on it.
You do not.
Yeah.
Better statement is you do not have the
You do not.
resources.
And I found out there's also patents insurance that you can get in case somebody infringes on that, and you can have this lawyers just go to bat on your behalf. But then the other part about like to patent or not to patent is that, for instance, you can use Google Patents to just read any patent. And if you're in another country, for instance, like China, you can just read the patent and just reverse build whatever it is. It tells you essentially how to make it. And
You don't think anybody in China would do such a thing?
so it ends up being a really tricky situation to patent or not to patent.
It
And I'm
does.
curious, when would you advise somebody to patent? Because it costs a lot of money and requires the defense.
Yeah, again, it's related to the individual company. There are individual circumstances in which you might patent or not, depending on what's going on. If I'm dealing with BMW and I've got a new engine that I'm going to show them, I want an NDA with them, right? And I don't want to patent it because I guarantee you BMW has covered 60 patents or 600 patents related to whatever it is that I've thought up. Yeah, so in other words, if you're thinking of patenting a product that is related to products that have been around for 100 years, IBM's products, I mean, IBM has the highest number of patents every year for like 2 decades. In other words, thousands of patents. Don't do it. It's not going to get you anywhere. Yeah.
And I think for this conversation around investment, a question like I was gonna add, like I've invested in plenty of companies that don't have a single patent.
Yeah.
And you said at the start of this, oh, hey, Can has investments from one patent to 27 or whatever it was. I'm betting that you've invested in companies that have 0 patents.
Oh, absolutely.
Yeah.
Yeah, I didn't mean to say that no. In fact, patents don't, personally, patents mean very little to me. Now, there are some companies that we've looked at where they have actually got a whole patent portfolio and they've got great counsel and they're doing it right. Yeah, that's a plus. But I think there's 2 companies that I've seen in 20 years where I invested because they had a patent portfolio that I thought was really strong. Otherwise, no, we've 80% of our companies don't have any patents. And to your point, it's highly unlikely that a startup with a patent is going to be any more valuable than a startup without a patent. It's the product, the market, the team, you know, their foothold, how fast they can move, et cetera. Whether they got a patent or not, the average patent case in the United States costs $2 million. So if you're a startup, you just raised $200,000 and IBM sues you, you're gone. You know, you can't defend it. So you give up. Yeah. Now, the strategy of big companies, at least the ones that I represented, was not to crush startups. I represented Bosch, for instance, huge German company, bought companies all over the world. And they look for technology. And their attitude was, it's great technology, let's just buy it. You know, it's cheaper, it's easier, you know, it's quicker. So I think in my 40 years, I think I saw them litigate twice on that kind of issue. They litigated all the time, the big players in the block, but not the startup. Okay, next. So what tools do we have? You know, we're talking about all these issues related to due diligence, but what tools do we have? The first is the investor presentation, the so-called deck. And everybody's deck has become more and more and more standardized because people go to seminars to learn how to make decks, and they read on the internet, and Silicon Valley folks and the law firms out there have been doing this now for decades. So a deck is pretty similar across the board. The idea, the team, the market, and the projections, as I said before. Projections are always wrong. The idea is hopefully better described in the entrepreneur presentation. It's rarely described well enough in the deck, in my experience. The team you got to get to know. Everybody, not everybody, but a lot of startups have a nice team. But then you really want to know, is that person who's listed, you know, PhD, MD, LLM, et cetera, from Oxford, Cambridge, Harvard, and Yale, are they really participating in the company, or are they just a face on the screen? Oh yeah, we're running out of time. So we send out, as I said before, the CAN due diligence checklist. Then we have interviews with the team, and then third-party sources, USPTOs, US Patent and Trade Office, distributors. We talk to distributors and customers. Yeah, I'm not bashful. Call up a competitor and say, hey, we're looking at this marketplace. What's going on? And, you know, your tool factory, Dave, I noticed you shut down, you know, your Ohio tool factory. What's going on? You guys shrinking or expanding? It's that sometimes you get good information, actually, from a potential competitor. So we look, I was going to highlight these. I'm sorry we ran out of time so quickly. On the intellectual property side, we want to know whether it's patented or not. Is the business unique? What steps has it taken to protect IP? Now you think immediately of patent or trademark, but also what steps has it taken internally? Yeah. Is there a confidentiality agreement? An employee doesn't have any obligation to keep things quiet unless there's an agreement with that person to do so. Can you confirm that the company owns the IP rights? Yeah, you can look at the USPTO, you can ask, and you should. Trade secrets, trademarks, I think most people are familiar with these. Assess protection of information. Do they use NDAs? By the way, I've practiced law for 50 years. I've never seen an NDA litigated. We sign them all the time. We negotiate them all the time. We fight back and forth, sign them, and nobody's ever litigated. Because you can never prove whether an NDA has been violated or not, right? That's the problem with NDAs. But there's sort of moral swage that relates to it. I wanted to get to, let's get to this. Let's take a few minutes. If you don't mind, I'm going to run 3 minutes over at least. So this is an example of the forecasting that we see. Base case, downside case, and upside case. So the reason I show this is just to illustrate briefly the kind of inquiry that would go on between me, the due diligence guy, and the entrepreneur. And I would want to know a lot of things when I look at these projections. Number one is, okay, you're gonna grow 411% in year 2. And you're gonna increase the number of customers by that amount. Now, how are you gonna do that? How are you gonna do that? Does that require salespeople? Is it all on the internet? What costs are associated with it, et cetera? In other words, I want to see the expenses broken out, and I want to make sure that the entrepreneur has answers to every element associated, every component of those costs. If the entrepreneur doesn't, then I'm suspicious, then I'm thinking immediately, is this team the right team? Yeah. Do these folks really understand their business, or they just put numbers on a screen? The expense items. So what does it take to produce the product? What does it cost? And where did you get that number? Yeah. Do you have an exclusive contract with a Chinese company? If so, in my book, that's a red flag. Is it an exclusive contract? Can I see that contract? What happens if that sole producer decides that your costs are going to go up 20%? You've built a market, you're going to increase 400, you've got 6,000 customers, 5,000 new customers, and now your producer says, you know what? It doesn't have to be, I don't want to pick on the Chinese. I just had a lot of experience in China. Not good, but it could be anywhere in the world. It could be in the United States. And the producer says, you know what? I can't produce those additional. I can only produce 1,000 units, not 5,000. What are you going to do? Has the entrepreneur thought about it? Probably, sometimes yes. You know, sometimes the response is, well, we've got a producer in Florida as well, and they're ready to back us up, and I've got a contract, blah, blah. If not, then again, I'm back to questioning whether the entrepreneur is the right entrepreneur. They should have thought about those kinds of questions, because stuff like that will happen. Yeah. Projections are never valid. If something always goes wrong. Yeah. You're going to increase this revenue because you've got your Uncle George, who is a fantastic salesman, and he's got connections to every major trade organization related to my product, and he can address them all next year. That's why I'm going to increase my customer. What happens if George dies? George got hit by a bus. Now what? Now, I'm being facetious, but it's a real example. If my sales are dependent upon one person and that person's gone, now how am I going to achieve that? And again, you're not trying to pin the entrepreneur down. You're trying to see if the entrepreneur has thought about it. Well, we've got a backup plan. You know, I've got 2 other salesmen that he's training, and hopefully they'll be through their 3-month training period, and then they have access to the same audience. Yeah. So the product. Oh, are there any ancillary? Are there compliance issues? You're producing a product that contains methyl aldehyde. I just made that up, but it's a dangerous product, and you're producing it on a contract basis. Yeah, but you're taking delivery of it in your warehouse. Did you buy a warehouse? Yes. And you're going to deliver it there? Yes, because it's cost effective. It's our own warehouse. We can ship when we want. Yeah, but you're storing hazardous waste or a hazardous substance. Did you think about that? Is there a compliance cost? Do you have a license to do that? Well, no, didn't think about that. We just thought it was cool to have our own warehouse. Now your revenues drop off from 400% to 80%. Why is that? Hey, you grew by 5,000. Why is your growth not exceeding that in the next year? Why is your revenue per customer increasing? Are the customers coming back and buying again? Do you have any experience, by the way? Have you tested the marketplace? Do you know that 80% of your customers repurchase? Well, no. Well, then why are you projecting them? Or why aren't you projecting, et cetera? So I know that's a real quick kind of analysis of a forecast, but you can see, I hope, the way a forecast can help you analyze the entrepreneur, give you a sense of whether this entrepreneur is the right team. And when I say entrepreneur, I mean the team. I always try to sit down with both or 3 teams, however many team members there are, and talk to all of them. Because scientists will not have any answers to what I just said, most likely. The business person, hopefully. But it's an opportunity and a vehicle that you can use to get good information about whether or not this is a jockey that you want to invest in. Put it that way. And then that's it. This is all about the investment vehicle that we use. We use a Virginia limited liability company. I set them up. It takes about 10 minutes. It costs $100. The naming convention, we always name our investment vehicles CAN, and then the name of the company LLC. We get a federal tax ID, open a bank account, and then all of our companies are housed at 250 West Main Street, which is my office up there. Sorry that I went over. Any questions? No?
Thank you, Craig.
You're welcome. What'd I do?
Yeah, that was really good. I learned.
Sorry, it was-
Every single time we do this.
It was quick.
A few things. The Charlottesville Angel Network is a group, like we said at the beginning, and we have associates in addition to our angel members themselves. One thing that didn't come up today that usually gets covered or somebody asks is what does it take to be a member of the angel group? What is an angel investor? What is the term angel investor, and accredited? So, members of the Charlottesville Angel Network are investors that are considered accredited. And accredited is really a term that the SEC defines. So it says you have a net worth of $1 million, not including your primary residence, or you have salary, you have income with yourself and or your spouse of X amount of money every year for the past 2 years. That type of thing. So the definition is the SEC's definition. It doesn't mean that you're certified. A lot of people think of the term accredited as meaning certified, and it's not. So that's one of the criteria to becoming an angel member of a group, not just our group, but other angel groups. But we also have associates, and associates are eager, younger, typically entrepreneurs who want to spend some time with angels before they become accredited, learn how this works, do some due diligence themselves. So they volunteer their efforts alongside our investors. So let's say Rebecca is the deal lead for a given deal. What we do is we look at 3 deals every month when we meet. And then of those 3 deals, every presenter, when they leave, we talk amongst ourselves and say, okay, who might be interested in this deal? And if you raise your hand and you're among 10 people to raise your hand, one of those 10 members of the group has to agree to be the deal lead. And the deal lead is the one who's going to manage this process. Now, we also have associates, and we have several in the room here that work alongside or can work alongside you. And Craig manages our associate program, so we'll match you up with somebody. We oftentimes also have co-deal leads. So somebody may be newer in the group, they're like, I want to do it, but I'm not sure about doing it. So somebody else will usually offer to work with them. And sometimes it's a matter of that person has industry expertise in whatever that investment could potentially be or that company is in. So that's a little bit about being a member of the group and being an associate. We also have been, myself and Rebecca and others have been really involved in work that the Economic Development, is it authority or administration? I always forget, EDA.
USC administration.
Yeah, so it's a federal grant that our community got, and we're helping to increase the pool of investors who are females and persons of color. So we have particular programs that we've been doing. One of them is called the Ascending Angels Salon. And it's a group of women that get together to share input with each other, to talk to each other, to ask the dumb questions and feel like you can do it in a safe space, and just to learn, And so the next one is actually going to be at Rebecca's house on July 24th. We just met and picked that date. So if you're interested in getting on our mailing list, if you are an accredited investor, we encourage you to reach out to myself or Rebecca. We can put you on the mailing list for that. It's just an email that we send out to let you know about those upcoming opportunities. And there are lots of other events that we do in the community. There's a film premiere coming up for a film called Show Her the Money. And we'll be promoting that a number of different vehicles. One is through the Ascending Angels listserv that we sent out. Rebecca, you want to add anything?
Yeah, just if you're not a member of CAN and you're an accredited investor and you'd like to come to the meeting, please let us know. We'd love to have you.
Yeah. That too. Thank you, everybody.
Thanks for your time.